Hey guys, welcome back to the channel. So today I have this day trading strategy which I'm going to backtest for you over 100 trades. I will tell you about the indicators that we're going to be using, show you a few examples, and then perform the 100 trade backtest. So this strategy involves only one trading indicator, and it's the 200 exponential moving average. So an exponential moving average, also called an EMA, is a type of moving average that places a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponential weighted moving average. An exponential weighted moving average reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. So this backtest is based on the 1 hour time frame with a 1:2 risk to reward ratio. So that means that every $1 that we risk, we aim to make a minimum of $2. So this strategy is offline, which means I will go back in time on the charts to test this strategy and see how it would have performed. Therefore, it doesn't take into account commissions or the spread or even swap rates. So if you don't know what that means, the spread is the difference between the bid price and the ask price. So at any given time, you can buy or sell any instrument, and usually the broker's commission is the difference between the price at which you will buy the asset, which is called the ask price, and the price at which you will sell the asset, which is called the bid price. So here's the strategy. So it's pretty simple. We buy when the price crosses above the 200 EMA, and we sell when the price crosses below the 200 EMA. And we place the stop loss at the last swing, which is usually going to be pretty wide. We've got no maximum trades that we can have open at all times. And as soon as the open profit is equal to the maximum risk per trade that we are taking, we move the stop loss to break even. And we have a minimum of 1:2 risk to reward ratio. So we put the take profit to the next swing in the direction of the trade, but it has to be minimum 1:2 risk to reward ratio. So let's get on the charts now so I can show you a few trades, and then we'll dive into the 100 trade backtest. All right, so we've got the US dollar against the Canadian dollar on the 1 hour time frame. So we'll go ahead and add the exponential moving average. Go to the settings, change it to 200, change the method to EMA, and then I will change it to white. Because I feel like you can see a bit better the crosses. So there you go. So essentially what you would do is you would look for the price crossing that line. So you would go short here, however you would go long here, short right here, and then long here, short there. So I'll show you a few examples and then we'll go quickly onto the backtest. So there you go, a few examples. This strategy involves quite a lot of open positions at a time, simply because the price fluctuates when it crosses that line. So essentially here, we would go long right here because it crosses from below. We put the stop loss at the last swing, and we aim for a 1:2 risk reward ratio. However, it crosses again, but to the downside. So we take a loss right here because the last swing was here, but we take a long again on that big bar. We put the stop loss at the last swing, and we aim for a 1:2 risk reward ratio. And then moving forward, it crosses again to the downside. So the last swing is pretty wide. So the take profit takes quite a while to be hit, but it does get hit. We take a long here on that bar, so that's a loss. But we take a short on that red bar, and that's a win on that wick. So let's go ahead. I'll do the back test, and then I'll see you for the results. There you go, guys. So we had a maximum drawdown of 30%. We were risking 5% per trade. The risk to reward ratio was a minimum of 1 to 2. We had 26 wins, 50 losses, and 24 trades that ended up break even. We had a maximum of 2 wins in a row and a maximum of 7 losses in a row. So that gives us a win rate of 34% over 76 days. So we end up with a total profit of 167.3%. So if you had started with $10,000, you would have ended up with $16,733 after 76 days. So this strategy is profitable. However, it may be worth trying this strategy on higher time frames, simply because on lower time frames, the price crosses the 200 EMA pretty frequently, so we take a few losses at a time. And if the volatility is pretty high, then even the trades that are in the correct direction might end up in a loss due to volatility. So let me know what you guys think in the comments. I'd be happy to try this again on a higher time frame if you think that it's valuable. And I'll see you in the next video.